Good evening. This is the Eye of the Storm podcast with the big picture update on Sunday, February the 19th, 2023. Tonight, I'll be talking about the S&P 500 cash index, the NASDAQ 100 cash index, the Treasuries, including the 30-year bond, 10-year, 5-year, and 2-year note, gold, silver, and the dollar index. I'm going to start right here on the SPX, but first I'm just going to talk about some general observations that I had last week. The largest one being the inability for the equity markets to kind of pick up on what the Fed and interest rates are basically telling us, particularly the Fed funds rate, that rate hikes are back on. We've already started the talk that it's going to be 50 basis points, but yet the equity markets are paying attention to it. I don't want to say they're ignoring it, but they're not dropping as much or as quickly as one would expect in the current environment. And a lot of that, in my opinion, was really drawn around the derivatives markets. And last week, we saw that there was a very large expiration on Wednesday, so 2 days before expiration. And the volatility dropped, and I think it really allowed the people holding positions that needed to be adjusted to do so. And then they expired, and then the market kind of got back to what it does until Friday's expiration came along, which then that was more or less centered around, of course, the indexes, equity markets, the bond markets, et cetera, et cetera. So we continued to have some interest rate pressure, but that was more felt within the Treasury markets and those options. In the equity markets, it continued to present us with a scenario that the markets were going to try to settle closer to 4,100 than 4,050. Now, we kind of ended up right in the middle. And as you can see, as we open in Globex this afternoon, the markets are lower right now. I don't think they're going to be moving a great deal. They may, but I'm assuming that they likely won't. But surprises do happen. In any case, I think that the markets get wrapped around these expirations. We've seen them that they've now increased their every day of the week, particularly in the indexes. And therefore, and then every Friday in all of the underlying. So all of the stocks and the components of our indexes have at least every Friday. But what they do every day affects, of course, the greater index than which they all sit. So we see these market moving, but not necessarily breaking down. So it's what I would call they have a floor and they have a ceiling, and everybody's kind of waiting for somebody to break one or the other. And so we're missing a large component in terms of traders and what they do and how they trade. And those would be the macro traders. It seems that there's a great absence of macro traders. And those are the ones that are paying attention. Interest rates are going up. What do we do? How do we position? What do we do for a possibility of a recession? What do we do in an extended period of higher interest rates, et cetera? What gets affected? And so what positions do we put on? And macro traders have kind of been silently absent. And I have to tell you, part of what I see, because I saw an influx of capital into Apple, into Meta, and into Microsoft, and then into Tesla. And I believe it was institutional money or hedge fund money, or coming in through particular ETFs. I don't know, but it was coming into those stocks, what I could see. And then I see that they continue to be the usual suspects and what's being held up when it comes down to expiration. So where are these positions within these stocks? And so I've gone through and I've kind of looked, and Apple, it's 150 to 155. In stocks like Microsoft, that's really, they raised it up to 276. And then it's traded quite some good volume up at 270-ish in that area. And now it has closed and dropped down to 258. So it's like where it sits there. So the points of most pain may have been reached in Microsoft. I don't know for certain. But again, then in Tesla, it's obvious it was 200. So what I'm seeing there, or what I feel like I'm seeing, is that in derivatives, so in the calls and the puts and the options, these stocks are being pegged at a particular price because that's where the positions are. Long or short, that's where the positions are. And so we saw it again this past Friday. How long that continues, I do not know. Now, beginning here with the SPX, you first thing you're going to notice that I have followed through and I have put the labeling for, and this is the weekly chart, for the minor C wave and the intermediate B wave. Remember, coming off the all-time highs, that I've got this double ABC working. Now, I believe what we should be dropping into right now is a intermediate and intermediate C wave down. And it should be very strong and very persistent and move and push the market lower. And the catalyst, as we know, it should be interest rates, and interest rates going up, and what that portends moving forward. Now, the market has yet to really break certain levels. The one right now is 40.50 in the SPX, 40.50 in the ES, in the futures market. So it becomes a very difficult game that gets played. Now, I'm going to move this down because right now, I'm going to go all the way to the daily chart. Right now, you can see that I'm ending it, but the B wave and the C wave end in a failure. The C wave in particular, because it did not take out the high. So the C failed to take out the high of the minute third wave of that C wave. But this counts as 5 up. So I'm going to put a failure there and then see where we go from here. Now, I cannot rule out that the market has an intent or the possibility that it can turn and run back up again. And if that's the case, then this is all very strange to me, and I'm not sure how I would count it, because on the SPX, we did come down and break below and close below the low of what I was considering wave 4, which is another reason why I'm putting the C and the B here, because it's like, well, if that's 4 and this is a 5, it ends in a failure. And it does appear right now that we are putting in 5, haven't completed it yet, but subdividing. And the very first leg down within the new intermediate C wave down. So what's the potential? What can we do here? Well, I'm going to go back out again. Actually, I think I can do it right off of here. Let me see. Yep, I can. I'm going to put the first in. If this is a C wave, let's just put some general levels of where that C wave can go. I'm going to be insisting that we be good on this. Come on, right there. Thank you. And then it's going to go to there, and I'm going to bring it up to the failure point. So most common in this, because the closest relative to that C wave is going to be the A wave. So I'm looking for an additional 5-wave structure down like we had here, looking for 5-wave structure down here. It's going to be pretty just much as severe, maybe even a little bit more intense within that center portion. In any case, if it's going to be equal, if wave C is equal to wave A, that's 3,325, I'm going to call it. That's where that 100% mark is. If I'm expecting it to become a little bit more intense, well, then we're looking at probably 31.29 down to 29.80. We come over here, we're like, well, what's that 3A2? This 3A2 represents a 38.2% retracement of the rally from the 1932 lows to the 2022 highs. That's a lot. That's a lot. So 40% already would just be at 29.80. Everybody's going to go like, wow, that's a big deal. Here's the bigger deal. that we have to start to consider where would this fourth wave, which on the upper levels is what it's putting in. It's putting in a cycle degree ABC to complete a supercycle wave 4. And that, in that case, where would we be looking for this? We'd basically be looking at to where the cycle degree 4 came in. And for the SPX, we're looking at the 2009 lows. And that's out there, folks, because what we're finishing, if we come down and complete this C wave down here, we're finishing primary wave A. Again, it's all part of how I've adjusted the labeling, and I did that via a degree. So it's putting things back into context. I am looking for a much larger, longer term, more destructive corrective phase here. And so when we jump and I fall guilty and prey to it myself, labeling back there that this would have been a primary B wave top, and we're in a primary C wave decline now, stopped and ceased to be more accurate. And so I switched it to the X and stayed within the intermediate degree move. And so we're still going to have one more because of what this all turned into, right? It turned into a double. So there's A, B, C, X, A, B, C, a double for that primary A wave. So everything gets shifted over, and it fits with what the market is doing, what the characteristics of the moves are, and what the characteristics of the move should be coming up, and what's going to be the catalyst for that to happen. I believe it will happen very quickly. So we're looking at that probably getting down to this low. Again, we're talking maybe 3 months, maybe less. So maybe by May or June, we'll be done with this C wave down. So we should have a longer period of basically lower markets. We'll see. We'll see. But I cannot discount and say it can't happen should the market decide to turn and come up. I won't know exactly how I'm going to count this entire production here, but I will until I really get an additional completed larger first wave down. I can't declare that the market won't turn on its heels. I'm not expecting it at this point. All right, so moving averages on the daily. You can see that the 50 crossed again last week. It crossed over the 200. This dashed line, also in the magenta color, is the SMA. The other is the EMA, both 200. And then this kind of orangey gold one is the 50. The 20 is up here, and that actually is where it closed. There's the 20, the market closed right on it. These have also now both hooked and are heading lower. Again, on a daily, they're going to take a little bit longer. What will increase our selling pressure is if the 4 and the 8 cross the 20, particularly the 8. If it crosses the 20, when the 20 crosses the 50 or the 200, etc. If this turns and starts to come right back over, I would think that the 200 remains flat, and then we roll, and this rolls back underneath. That's going to add additional downside pressure. All right, I'm going to go over to the NDX here. It's the same story in the NDX, and I've left it here as well. This one has yet. I'm going to first open up and go down internally. So I want to go to this here. We have not taken out the low. This low was actually 12,204. We got on Friday down to 12,033.8. So we've not created that new low below 4. So here it could be a very extended move. I don't necessarily see it because it would be a 4, and on this degree it truly changes, and I'll show you that whole thing, because this would be a 4 against this being the 2. Is it possible? Yes, it is possible. I'm not going to deny that. It's not what I'm looking for, and I kind of would have a problem, but the NASDAQ has thrown me more curveballs when it comes to Elliott, because it's stretching the guidelines and the rules for me instead of me doing it. The market's doing it. So I basically, that's why I say yes. Is it possible? Yes. But the market basically has to stop pretty much here. I would think that if we do finally break below that level, if it's in the Globex session today to tomorrow morning, and then again, we have tomorrow, Monday afternoon, where Globex will open again. Tomorrow during our regular session, we, of course, are on holiday. But in any case, if we do start to get below that level, this is the cash market. So 12,000, let me get that over correctly. 12,204. Basis the cash. So again, I'll be updating the futures markets tomorrow afternoon. So I am going to consider it that it's done. I am looking at this in the way that here are my fibs coming off. So if I had to count it from here, also in a failure, so the 5, and that's kind of hiding up there, but that would go right to here. I have 1, 2, and then 1, 2, 3, 4. We got one more down, it's a 5. And then I'm just done with the third, and then I get a 4 and a 5, and then I'm done with the absolute first wave down. It's likely going to be minute degree. So we're working within the constraints of an intermediate C wave, a minor first wave, a minute finishing the third, still a 4 and a 5. So we're in the minute first wave. And then we get minute 2, 3, 4, and 5 for minor 1. If these are minute, I don't want to go too fast. So I don't think they're minute. We need to get below here. We need to break and start breaking quicker. Get below 11,200, get below 11,500 and start to drop. Now, what can we look towards if indeed the intermediate C wave down is in force? Well, 100%, again, looking at that relationship that it's the C wave related to the A wave, 100% is 9,409. That's 100%. Sub 10,000 again. Here we go. Now, if it decides that it's going to be more intense, as I suspect it may be, then we're looking at 86.35-ish down to 8100. This sits down there on the bottom. This, I would think, more in terms of the entire C wave can bring us into this level, and then we get a primary A. Primary A, same as we talked about the SPX, we have in the NDX. Then we get another tense rally. So as I said in the SPX, what really has changed is, like before, I was terming this as cycle degree because I was using this as primary A finish, primary B finish, and we're in the primary C wave decline. I no longer would suggest that based on how the market is traded right in here. So it did not break the rule in terms of breaking that high, but I think it's cleaner to do it as a double ABC coming down, finishing the primary A wave. Primary B should be as not so exuberant and totally euphoric as a cycle degree because it's even bigger, but it's big enough that we should definitely get back up into here, up into these upper levels, even from down here. We would for sure, I would think, can start to work our way back up to where we're just going to drop from. And then we have, again, a primary C wave down, and that then just finishes cycle wave A. So again, we're back on track in terms of my longer term view. So those are the two equity markets. Here again, on the 4-hour, let me go out to the daily, just take a peek. We have the moving averages really kind of giving mixed signals. Some are turning. The 50 is kind of touching that SMA, the 200 SMA. So mixed bag, but I think that would straighten itself out again when we're looking at the 20. Now on the NASDAQ, it came down, touched the 20, but it managed to close above. They knew, like everybody else did, that's how you keep alive the potential that you're going to go up and try to make new highs. Keep it alive, but I think that can be given up pretty quickly. All right, over in the bond market. Remember, bonds sit at the top of the food chain or the top of the pecking order. That's just the way it is. And from there, interest rates come down to treasuries, come down to currency, come down to corporate, come down to retail. You and I, folks, we're retail. The big guys, they're corporate. Apple, et cetera, JP Morgan, the trader. Those are the corporates. Above that, we have the currency. And of that, we have the treasuries, the bonds. And above that, we have the interest rate itself. So it's interest rates that sit at the top. They control everything, unfortunately, or fortunately. So it depends on what environment we're living in. We're coming off of an environment, a very, very 12, 13-year environment of basically low rates. And certainly for the last 2 years, very low rates. So actually, 2 years, to 2020 to 2022. I take it all back. So in any case, looking here at the 30-year bond, we've already completed our first 5 waves down off of the bond price high, the yield low. We finished 5 waves down into the mid-October. And then I've labeled that as intermediate wave A. Again, I know I'm working on an intermediate degree. And then from there, I'm looking for an ABC, so a minor degree ABC to complete an intermediate degree B wave. Now, within that, I still hold that we still carry a lot of potential here in the 30-year bond, that this was the A, the minor A, and these are all part of the minor B, which may have bottomed on Friday. We may have one more drop down. We could get even a lower, get below 124.11, but that level continues to hold, and it's actually pretty strong, as I anticipated it could be, based on this being an absolute letter perfect flat ABC structure. Now that remains. It could even come down a little bit below, and it's still going to end up being a very clean, flat structure. What would change that picture is if this was all of, now remember, I'm looking for an intermediate degree, if this was the entire ABC and therefore completed that intermediate B wave, and we're starting to head into the second series of larger 5 waves down. I'm not necessarily looking for that, but I cannot disqualify it and say can't happen. When you start to get that rumblings coming in from your 5-year, your 2-year, and also your 10-year, they're not out of bounds yet. But if we continue to get intense, as the Fed funds are suggesting, we're going to have to make adjustments. All right. Fed funds are already suggesting that Fed fund rate is going to be above 5%, 5.25%, or even higher. So they are taking into consideration, and solidly, that the Fed does continue to raise rates. What we're seeing here in the third is, well, how are we going to price that in? This is a 30-year bond. If we're only expecting inflation or whatever for the next year or two, what are we? Yes, those rates are going to be affected. The entire sector, the entire ladder is going to be affected. Right now, the yield curve is inverted. We'd be looking for the lower yields to be paid on the short term, with the longer term bond carrying the higher yields. So we are kind of been inverted, and we've been inverted for a while, and that's going to continue. Primarily because we're not really considering right now that inflation, higher interest rates are here for a longer period of time. Now, that could be the surprise. I got to tell you, that could be the surprise to the market. We'll wait and we will see. Right now, in the 30-year bond, if 124.11 holds and the market continues to rally, and they're up ever so slightly, are they? Yeah, they're up, basically unchanged. But if we start to head higher, we're going to have these levels will also come into play, coming all the way back. But eventually, if we can build on a 5-wave structure up, we're going to be suggesting that this is the C, and a minor degree B wave would go underneath it, suggesting 1, 2, 3, 4, 5 to come up, and we at least break 135. That's the good news. If you want to have lower rates right now. If you don't care, whatever, and if you, well, actually, if you're secure in equities, well, you'd love to see that. That brings about a whole nother narrative. Everybody starts talking about Fed's going to pivot, Fed's going to pivot, but yet to be seen, not in the picture right now. So, but it is and remains in my picture for the bond market that we can have an additional rally, 5 waves rally. And then we're looking here with an outside chance of 146. Again, I'm not looking for it, but it's out there. 135, yeah, that much I can see. So what's that puts us? Maybe 3.5 again. Right. So I told you where we closed, and right, we looked at this. The 30-year bond closed on Friday at 388. So it went up 5 basis points. So we're up 25 basis points. So we're halfway there to, if they're expecting, 50 basis point hike next, they're not pricing that in yet. We still got time. So if that's the case, we continue to go lower. Okay. Bond prices lower, yield goes up. Okay. Now, that's the story in the 30-year. The 10-year, a little bit bigger moves. We did actually come down and get below the support that we had here at this price level, but it still fit very cleanly inside the overall structure. So because this does count pretty cleanly as 1, 2, 3, 4, 5, this is an A wave, A, B, C, this is the B wave, and we will. So the 10-year continues to argue that we have one additional leg up. I would think it's going to come pretty quickly, simply because that other outside pressure, and I'm trying to, the compression, it gets bounced back up, that the pressure cooker releases a lot of that steam, close it again, and now it's building. And then maybe next time what happens is that not that it explodes higher, it explodes back against the market. The steam just goes and it just drops. So pressure, but a quick buildup and then the breakdown. So that is very possible. And I would suspect it happens quickly because of the other additional pressure on our economies and what's happening geopolitically and what could surprise this market and toss it for a whole different look. So the 10-year does have both. If the 10-year turns, and we can get the 5 waves up, I'm definitely looking for something above 116. Again, if we get 5 waves up, not just a little up to 112. I mean, it's got to come out in 5. And it has to build toward it, and it has to have the same characteristics and everything that I look for to just call it a 5. So we're not even there yet. So we have to keep that in mind as well. A good start. I will not deny that's a great start. Look at that. On the 1-hour chart, very strong. Off of that low, nice and strong. Nice little run. So very tradable, I should say, as well. Again, both, this is what I also like about the bond markets. They have come back to life and they are very tradable. Very tradable. Beautiful volumes, beautiful moves. So you can get in there and you can do a whole lot. And they are day tradable. Very much so. All right, over in the 5-year note. If I can get over to the 5-year note. 5-year note, same deal. I got to pull it out here to my daily. We're coming down a little bit different. I didn't give you the 10-year. Excuse me. I'm doing that on purpose, I think, but not totally intentional. Let me go out to that monthly to show you that. Remember that the 30-year finished Friday at 3.88. The 10-year finished Friday at 3.82. So 7 basis points higher than the Friday before. And from here, we're almost 30 basis points higher from where we finished on February the 3rd. So in 2 weeks, almost 30 basis points rise in the 10-year note. We keep talking about, well, we got a 25 basis point hike. Yep. And now the 10-year note is adjusting above. Just so that you understand. All right. So, 5-year note. Finished back at 4.03. So here as well, we have a 36 basis point hike in the 5-year note from 2 weeks ago. So in 2 weeks. And when we're looking at it coming off, it's very strange because it could definitely be a B wave. And the 5-year note does carry a lot of potential. It's coming down. It hit what I would consider what we call the sweet spot, which is an old market maker. Market makers that traded in the SPX, actually. But Board of Trade, Mercantile and the Board of Trade, the bond pit, everybody probably used the same levels. So I do consider it pretty valid because look at this, it bounced right off of it. So if I'm looking at this thing, going like, what do we got going on here? I just bring it up there. It came right down and came below that 106.300. It came down to 2.7. So what could that suggest? Well, if that bounces off of here, I've got a 1, 2. Remember, I'm looking for a C wave, right? Or an A, B, and then I'm looking for the C. And I could probably get 5 down to there if I called it a C, and we're kind of coming up out of that mark right there. Nice. Looks like it's coming up in 5, a very quick 5 on the hourly chart. So if that gets 3 down, we should do at least another 5 up, and maybe that's only a 4, and then we go back down. So again, we've gone from 106 to 107 on the 5-year note, and that was all Friday. Nice volatility, very tradable, but still pressure to sink. And we were a lot lower, but still managed to close with that jump. All right, so finally in the 2-year, here we are. And what we got going on here, same deal. We got a little bit closer to the bottom of A, which would make this all a flat. So in the 2-year, we would no longer be looking for this thing to break and start getting up towards its full potential. It turns into a flat. Even if we come back down, we hold this, we still could rally back to the 103 level, right? 101 to 103. 2 years going to be under a lot more pressure. So you begin to see the yield curve trying to adjust itself. So, and here in the 2-year note, it closed at 4.60. So this thing jumped, right? 4.6, this 30 basis points in 2 weeks. All right, so that is all of our treasuries, and they are very active and they are very tradable. If you have an interest, drop me a note. I'm going to go over and take a look at gold. Gold continues to drop as it tries to react to what's happening in the currencies. But the dollar is going to continue to go up and interest rates are going to fluctuate. So I think it really kind of puts it back into where it could rally. And I would be expecting some type of a rally from here. We got those 2 big drops and then, yep, it continued to go down, but not as slam dunk. We had a few days where they kind of came in and they decided, no, we're going to buy it. So I have changed the labeling just a little bit. I'm putting away 4 down there, and now we're kind of like maybe completing one of what will turn into a larger 5 waves up, which was my original intent here. Degree-wise, I know I'm going to have to make adjustments. I'm not sure on the degree. I will work on that so that we know what level we are in terms of going up. But I do suspect that we need to just honor our support levels, which are 18, I'm going to call it, down to where that to 1815, which is where the daily 200 comes in. EMA, SMA sits down at 1770, 1780. And then we have 1775, and then we have 618 at 1735. Those are possible, but I would think we get a little bounce here, even if we are going to come back down and come into here. And then I can call that a wave 2. Silver, no real changes to make in silver. It is still one kind of maybe sick looking puppy. But we got up there. That spike high was interesting. And then just kind of beep, 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 starts to come back down. Now we've almost reached the 382 level, and that would be just for this whole corrective move. And if it is going to form three, and we're going to be looking for here to here to here. It has full potential to come all the way back if I'm calling this an A, and then we're going to get an A, a B, and a C, or some variation thereof. Right now, I'm going to call it, we need an A, a B, and a C. So that's what we're looking for in silver. So I think there's still additional downside to come, but we may rally back. And then we got 22.40 up to 22.65-ish to where these moving averages are. Finally, over in the dollar did spring back to life. And that basically fits cleanly to what I'm kind of looking for here in the dollar. Even, again, I don't know about degree size, but I'm calling what we finished up here as an A wave, and now we're in a B wave decline. So if I bring this out and go to here, right, we get that whole thing that was an X wave. There's the A, and then we get a B wave. So we're going to come up. So within the B wave, we're in the B wave. That makes all sense, right? We did a nice A wave down. I think we get a B wave back up to 106.78, maybe even as high as 9, right? Those are our fibs. 618. Then we have an outside fib, which I don't look at. I look at the 107, 108 to 109.50. And then we have down below that 106, 152, 105 belongs out here. And that one isn't as suggestible right now. But we do have this. We have 104. That's it surpassed. It got above, and now it's come back below, and now it's sitting just below it. I would suspect that we're going to continue. Bringing it down, though. So the weekly charts, bringing it down to the daily. The daily, 1, 2, maybe kind of starting to go. It's a very interesting little chart because you're looking for the formation to come in either as an ABC or as 5. Right now, it's an ABC. So we got up, and then we did a really pretty strong collapse, but a lot of that was violent, just expiration on Friday and in the bonds, et cetera, et cetera. So in any case, if we get rates that really go on a scorcher again, they're going to be buying the dollar, and so I would suspect that we get back up there. So we're going to keep an eye on this. I want to see how this all trades internally, but I know that there are trades when you're using the dollar and you use the various futures. You can do some crosses in here, et cetera, et cetera. But on the little bit longer term, I am looking for the dollar to get above 106, start heading into this zone before putting a C wave down. So I'm not going to call this all of B. I think it's just the A of B. It's going to take longer, and then we got another travel down, which coincides with a lot of things that could happen in the interest rate market, et cetera, et cetera. But again, if not, and we're just going to start from here to go rally, and then I'd have to somehow, this would have to work out to be an ABC, and I suppose I probably could with a lot of study and breaking down what all this was. And if that's the case, we're working on putting in 5 waves up to give us the announcement that that's what happens. That's what's happening. It doesn't look that good on the hourly for that. Even on the 4-hourly. Very possible, it is possible, but we'd need more trading. All right. I am going to stop right there. I do have a couple of things that, one thing is, if you have any questions, please leave them in the comment section, and I will answer you, or share your own count. That works out as well. One thing I want to bring up is that I intend to, you know that I've been sharing the podcasts with Dan Ascani, and we will be doing one tomorrow, which is going to be really talking about Dan's latest blog report, which should be being put out on defendingyourmoney.com very shortly, but he'll have more on that tomorrow. But we're going to be discussing that. And it's what the expectations are currently in the type of market that we're dropping into and why it's not happening, et cetera. So we're going to get more into the nitty-gritty and try to get behind the curtain so that people can get a clearer understanding of what they can expect from our markets. Also, Dan and I have determined that we want to expand my current trade room, which is the logical signals trade room, and where both of us would be on deck. We would both be present each day for the market, and that brings several new layers to the analysis that could be provided on an intraday basis for day traders, swing traders, option traders, etc. So we're kind of expanding what information we would be putting out there for other traders to make their own decisions in terms of options, futures, and any combination thereof. So if that is an interest of you, again, please tell me in the comment section, or you can drop me an email at michael@mjf1partners.com. Ask any questions or just drop an email of interest, let's say. Anyway, thank you very much for hanging out with me this evening. And I will be doing an Elliott Wave update tomorrow after Globex opens, as well as the Eye of the Storm podcast, where Dan Ascani will be discussing his latest blog report.